Good day, students. This is Professor Alexander Burkholz coming to you for Accounting 446, Chapter 12, Financial Reporting and the Securities and Exchange Commission. So again, this chapter we're going to really discuss is much more theoretical than we've seen before, really talking about what the SEC is all about. The SEC was born on June 6, 1934, really when we had a lot of disparity going on with the Americans. Again, the stock market had just crashed coming out of the Great Depression. So really, this was a very distressful time, the system in array, and confidence was eroded by the 1932 indictment of Samuel Insull for alleged wrongs and collapse of his utility empire, and by the 1933-34 Senate hearings on improper market activity. Financing of U.S. industry depends on billions of dollars of stocks, bonds, and other securities sold to thousands of individuals, corporations, trust funds, pension plans, mutual funds daily. Investors must be able to assess the risks that are involved. The disclosure of sufficient accurate information is imperative to stimulate the inflow of large quantities of capital. With inadequate or unreliable information available for decision making, investing becomes little more than gambling. So let's look at our first objective, which is to understand the origin and the expansive role of the SEC. The SEC is an independent agency of the federal government, established, as we said, by the SEC Act of 1934. Authority applies mainly to publicly held companies. Guidelines and requirements have a major influence on the United States on the development of all generally accepted accounting principles, U.S. GAAP. The mission of the SEC is to protect investors, maintain fair, orderly, and efficient markets, facilitate capital formation. The mandate is to ensure that complete and reliable information is available to investors. The work of the SEC. The SEC is headed by 5 commissioners appointed by the President with Senate consent. Only 3 of the 5 can belong to the same political party. The chair is usually from the same political party as the President. Commissioners serve 5-year staggered terms, and they generate significant fees from the 8K, 10K, 10Q, and registration statements, which again implies that the SEC is a fully self-funded agency. The SEC is comprised of 5 divisions and 23 offices, including some of the following. The second objective. Describe the purpose of the various federal security laws. So again, the Industrial Commission created by Congress suggested in 1902 that all publicly held companies should be required to disclose material information, including annual financial reports. The crisis following the stock market crash of 1929 and the widespread fraud subsequently discovered were necessary to prompt Congress to act in hope of reestablishing trust and stability needed for the capital markets. Congress enacted the Securities Act of '33, which was called the Truth in Securities Law, to regulate the initial offering of securities by a company or underwriter. The Securities Exchange Act of '34 created the SEC and regulates the subsequent trading of securities through brokers and exchanges. The goals of the SEC. The SEC has attempted to achieve several interconnected goals, including ensuring that full and fair information is disclosed to all investors before the securities of a company are allowed to be bought and sold, prohibiting the dissemination of materially misstated information, preventing misuse of information by inside parties, regulating the operation of securities markets such as the New York Stock Exchange and the various over-the-counter exchanges. Scandals of the 2000s. A cloud has rested over the entire U.S. capital market system since the early 2000s, where we had a number of highly publicized corporate scandals, shaking the confidence in the markets, accountants, and auditors. Why? Greed by corporate executives. Failure of corporate governance as practiced by many boards of directors. Failure of public accounting firms to apply appropriate quality control measures to ensure independent assessments. Some of the many reasons continued: shortcomings in accounting profession used to self-regulate the accounting profession. So again, prior to Sarbanes-Oxley of 2002, the profession was self-regulatory. After 2002, some of the accounting profession came under government regulation. Other reasons: unreasonable market expectations and a workload that overburdened the SEC, which the relatively small agency could not handle. The most vital responsibility of the SEC is ensuring that a company discloses sufficient reliable information before its stocks, bonds, or other securities are publicly traded. Reported problems that became the scandals at companies such as Enron, WorldCom, Adelphia, and Tyco still drew increased attention to this. Unless specifically exempted, all publicly held companies must periodically file detailed reports with the SEC. The SEC requires and regulates these filings as a result of a number of laws passed by Congress over the years. Full and fair disclosure laws. Laws passed by Congress over the years, again, the SEC Act of 33 and 34, the Investment Advisors Act of 1940 and the Securities Investor Protection Act of the 70s, Foreign Corrupt Practices Act of 1977, Sarbanes-Oxley of 2002. Again, skipping over some of these acts, but going over some more of the more well-known ones. The SEC's impact on financial reporting basically stated that in addition to audited financial statements, Rule 14c3 of the 34 Act required the following to be included in proxy statements sent to shareholders: 5-year summary of operations, description of the business activities, 3-year summary of industry segments, list of company directors and executive officers, market price of the common stock for each quarter of the last 2 years, restrictions on the company's ability to pay dividends, management's discussion and analysis of financial condition. Required certain disclosures and proxy statements describing the services provided by the registrant's independent external auditor include all non-audit services provided by the independent auditor, whether the board of directors approved all non-audit services and considered whether they would impair the auditor's independence, the percentage of non-audit fees to the total annual audit fee, and individual non-audit fees for more than 3% of the annual audit fee. The third objective: understand the congressional rationale for enacting the Sarbanes-Oxley Act and the responsibilities of the Public Accounting Oversight Board. So, In 2002, with Enron, we had a situation where the former chair and CEO received $152 million in payments and stock in the year the firm collapsed. WorldCom CEO Bernard Evers borrowed $400 million from the company that had improperly accounted for $9 billion, and the company went into bankruptcy. Adelphia, again, founder and CEO, conspired with others to loot the company. Drastic actions were taken in 2002 to reform what was going on in the markets, and this was the most far-reaching changes since Franklin Delano Roosevelt's New Deal. The public accounting profession was one of the major impacts of Sarbanes-Oxley. The public accounting profession is self-regulated. However, after the Sarbanes-Oxley Act, a piece of it came under government regulation. The American Institute of CPAs, AICPA, established its own code of conduct. The profession had also the Auditing Standards Board, which created standards for many years. However, once this scandal occurred on a variety of fronts, self-regulation was no longer successful. The Sarbanes-Oxley Act created the Public Company Accounting Oversight Board to oversee auditors of public companies, which basically meant that the AICPA no longer had jurisdiction over that. Now, for a company that audits non-publicly traded companies, they are not subject to the PCAOB. They are regulated by the AICPA. The PCAOB has 5 members appointed by the SEC, 5-year terms. Only 2 members can be accountants, past or present. The PCAOB creates auditing, quality control, and independent standards and rules. It is under the oversight and enforcement authority of the SEC and is funded from fees levied on all publicly traded companies. Registration of public accounting firms. Registration of public accounting firms is required only of firms that prepare, issue, or participate in preparing an audit report for an issuer, basically an entity that issues securities on a publicly traded exchange. Nearly all public accounting firms of significant size must register. Small firms do not, but again, need to be auditing publicly traded. Foreign firms that play a substantial role in the audit of an organization that is securities registered in the U.S. must register with the PCAOB and follow the rules of the Sarbanes-Oxley Act. Sarbanes-Oxley required of accounting firms in the application process included a listing of all accountants participating in the audit report of any client qualifying as an issuer, again, issuing publicly traded stock. Annual fees received from each issuer with the amount separated as to audit and non-audit services. Information about any criminal, civil, or administrative actions pending against the firm or any person associated with the firm. Information regarding disagreements between the issuer of the auditing firm during the previous year. The fourth objective. Describe the SEC's role in establishing generally accepted accounting principles. Well, the primary focus is on the regulation of the independent auditor and auditing standards. It hasn't had a great deal of impact on the registration of securities with terms of auditing. Therefore, FASB, Financial Accounting Standards Board, is the one that we believe is the main standard setters body for financial accounting. It's not the SEC. The SEC is more involved with the auditing regulation for publicly traded companies, not on the accounting. The SEC also has authority, again, after extended debate. The FASB issued a statement requiring oil and gas producing companies to apply the successful efforts method when drilling, accounting for unsuccessful exploration and drilling costs, again, because of the SEC. As another response to such problems, the SEC often required the disclosure of additional data if the current rules are viewed as insufficient. As a response, the SEC immediately established a moratorium on the use of this practice until an alternative approach could be evaluated. Companies filing with the SEC were not allowed to follow established methods of the FASB. This was after years of formal study and deliberation by that body. The SEC's relationship with private sector accounting bodies. Under federal law, the SEC has the mandate to determine accounting principles for publicly traded companies, but it has generally ceded that authority to private sector accounting bodies such as the Financial Accounting Standards Board. The SEC retains the ability to exercise its power with regard to the continuing evolution of accounting principles. The chief accountant of the SEC is responsible for providing the commissioners and the commission staff with advice on all current accounting and auditing matters and helps draft rules for the form and content of financial statement disclosures and other reporting requirements. The fifth objective, define and describe an issuer's filings with the SEC. Again, legislation requires registrants to make numerous filings in two basic categories, registration statements and periodic filings. Registration statements ensures the disclosure of sufficient relevant financial data before a company or its underwriters can initially offer a security to the public. In 2013, talking now about the SEC fees, the SEC charged a registration fee based on the value of securities offered, $136.40 for each 1 million, a fraction of the offering. Fees in excess of cost create a surplus that is a source of debate. Some consider the excess to be a source of general revenue for the feds, and others argue that it indicated corporations were being overcharged for the registration process. A registration statement must be filed with and made effective by the SEC before a company can offer a security publicly. And again, below we leave for you to look at some commonly encountered registration statement forms. The sixth objective, describe an issuer's registration process, various forms used by the issuers, and the exemption from registration. When registration statements are delivered to the SEC, obviously there's a whole process. Analysts determine if the financial information complies with the disclosure requirements. The Division of Corporation Finance regularly requests clarifications, changes, or additional information, especially for initial registration. A letter of comments is issued to the company to communicate these findings. And a registration statement is made effective when the division is satisfied the company has fulfilled all SEC regulations and securities can be sold. Generally, in a registration statement, it has a prospectus that contains the following. Financial statements audited by an independent CPA with appropriate supplementary data. An explanation of the intended use of proceeds generated by new security sales. description of security risks, description of business and properties owned by issuer. Part 2 contains primarily informational needs of the SEC staff. Offerings may also be regulated by individual states, which do vary. And there are some securities exempt from registration. Securities issued by governments, banks, and savings and loans. Offerings less than $5 million. Securities by a nonprofit. Private placement of securities to less than 36 investors who already have knowledge of the company. Periodic filings with the SEC. Once a company issues securities publicly traded on an exchange or an over-the-counter market, it must continually file information with the SEC to provide adequate disclosure. Some of those which we commonly know are the Form 10-K, the 10-Q, and the 8-K. In the 10-K, that's the audited financial. The 10-Q is when the financial is unaudited. The 8-K is when usually there's a unique happening. Proxy statements. Proxy statements must be filed with the SEC at least 10 days before being distributed. The proxy statement needs to indicate on whose behalf the solicitation is being made, must disclose fully all matters that are to be voted on at the meeting, has to be accompanied by an annual report to shareholders. SEC regulation of the proxy statements has greatly enhanced information. EDGAR, the Electronic Data Gathering, Analysis, and Retrieval System, designed to reduce overwhelming paper flow into the SEC, allows for public access to SEC filings and information through the Internet. Virtually all publicly held companies are required to file their SEC reports electronically. Paper filings, when permitted, are also converted to electronic files and available to the general public. Extensive database move financial reporting to a significantly higher transparency level. So this EDGAR, very powerful even if you wanted to do your own research. And that concludes, again, our chapter on financial reporting in the SEC, much more theoretical, not so much with the debits and credits. Please review this chapter one more time before doing any and all exercises associated with it. And we'll see you online real soon.